Correspondent banking relationships are a useful means for banks to extend their services beyond the jurisdictions they operate in by using a foreign bank as a proxy. But this indirectness can aid concealment, perhaps concealment of money laundering.
Effectively, correspondent banking relationships are agreements for one bank to provide services for another in jurisdictions where the first bank has no physical presence. It's basically a customer-supplier relationship. The respondent bank is the customer, and the correspondent bank is providing the services. The relationship allows the respondent bank to move money via the correspondent bank's accounts, so it can offer its customers a range of services in countries where it doesn't normally operate. There are inherent risks in the relationship because in many of these transactions the correspondent bank has no direct contact with the customer entity, so it has to rely on the efficacy of the respondent bank's customer identification and due diligence effort.
I'll give you an example based on an actual case. We have a money launderer, let's call him Mr. X, and let's say he's a citizen of country A. He registers a bank called Acme Bank in country B. This is just a shell bank. It has no physical presence, no staff, no remit, other than to serve as a vehicle for Mr. X's money. So he deposits 25 million US dollar in this shell bank. Now, he can go to countries C, D and E, styling himself as a representative of Acme Bank and establish correspondent banking accounts in Acme Bank's name. Then he can use the correspondent banking services of the host banks to transfer money to countries C, D and E from Acme Bank's accounts in country B. Well, of course, Mr. X then moves money across jurisdiction with these correspondent banking accounts and uses it to purchase higher value and highly tradable goods.
A money launderer doesn't have to create their own shell bank to take advantage of correspondent banking. They can use an existing bank. It's all about concealment. The money is transmitted via the respondent bank's accounts and not via their personally named accounts. That's the key thing. And the correspondent bank is relying on the respondent bank to do the due diligence, KYC, source of wealth and so on, so that if customer identification isn't up to scratch, all the better for the launderer.